Hello, I'm Leo Schmidt, the chair of the Institutional Asset Management Group. I'd like to welcome you to our first of a series where we have fantastic companies who come to speak to us. Texas Instruments is our exemplary company today. I'd like to introduce Dwight C. Blazin, who will be our questioner and helping us with this fireside chat. Dwight joined Davis Advisors in 1995. He was previously a consultant for IT consulting and systems design. Mr. Blazin received his PhD and MA from New York University and his BA from Brigham Young University. Next, representing Texas Instrument is Dave Powell. He is a vice president and head of investor relations, where he oversees communications with TI's investors community. Previously, he has served as a director in the department. Paul started his career at TI more than 30 years ago as an applications engineer. He then worked in sales and sales management in Silicon Valley for 8 years. He returned to Dallas as a marketing manager and then moved to Houston as a program manager. There he managed the development of more than a dozen new products with teams based in Houston, Dallas, Tokyo, and Bangalore. Later, he served as a business manager of several product lines in what is now TI's embedded processing segment. Paul holds a Bachelor's of Science degree in electrical engineering from Michigan State University and a master's degree of business administrations from the University of Texas at Austin. In addition to his role at TI, Paul serves on the board of directors of the Dallas Symphony and previously co-chaired Michigan State University's College of Engineering Alumni Association Board. I'd like to introduce you, Mr. Dave Paul. Thank you.
Okay, thank you, Leo, and thank you to the CFA Society for hosting us today and for the opportunity to talk about Texas Instruments. We thought we'd focus today's discussion around capital allocation. It's something that we take very seriously. I'd like to thank Dwight for agreeing to chat with us today and host the fireside chat portion of today's discussion. And hopefully during that discussion, we'll discuss a little bit about how we have learned from each other and certainly how we've learned from you over the years. So we appreciate it. Let me jump right in. I thought I'd just start with a few prepared remarks in case everyone's not familiar with Texas Instruments. So if you're thinking about Texas Instruments and your first thought is calculators, we may be related because most of my family actually believes that that's what we do. And so for those that know us better, they know that represents about maybe 2% of our revenues overall. So it's still an important part. Here we've got trusted by teachers and loved by students. I'm not sure love is the way that a lot of kids would describe their relationship with their calculator, but they are very, very useful. But if you look at our company overall, last year we had about a little more than $17 billion of revenue. The vast majority of that was in two markets inside of semiconductors called analog and embedded. If you're not familiar with analog and embedded, don't be shocked. I think most people outside of the industry may not be familiar with those technologies, but they're essentially in everything. And analog products have two main functions. They either convert energy from the wall or a battery into what we need in electronics, or we're analog beings. We live in an analog world, so whether that's temperature or pressure or light or whatever it is that you'd want to sense, we've got sensors that sense that, convert it to a digital signal, and pass it off to something to be processed. And that's where embedded processors come in. So, AI is the big hype today. NVIDIA or Intel are people that make processors, and those processors go into big machines. Embedded processors, if you need something that connects to a thermostat or I'm holding a remote in my hand, these all have embedded processors in them to make them work. And that's a good proxy for what that looks like. So most of our revenues were in those two areas. You can see other, that's where calculators would sit as an example. When you look at end markets, we've got almost 75% of our revenues now in the industrial market as well as automotive. But again, the other markets are important to us. We believe structurally that industrial and automotive will be the markets where growth will come from inside of our markets. To give you an idea, we've got 80,000 different products that we sell to over 100,000 customers. Most of our managers and our sales team, if there's not a customer or if anyone can find a customer that's not buying TI products, please let us know. We'd like to have a discussion with them. But we believe we're likely in just about everything that's manufactured from an electronic standpoint in the world. So that's what that looks like from an overview. So now if we begin and move the focus to what we're trying to achieve as a company and look at our objective and strategy, first I'll also kind of back up and talk about the culture at the company and describe it wasn't one moment or one big epiphany, but over my 30 plus years at the company, I'd say one thing that we made decisions were from the view as an owner. And that may sound like something you'd put on a slide, but as you decide what the right thing to do is, and when we're sitting in discussions, in meetings, and we're facing a large discussion or a large decision, those discussions come to at some point of like, what would we do as an owner? What's the right thing to do? And that can cut a lot of the fog out of where you want to be and where you spend your time and effort. And part of the outcome of that is our objective, which we describe here as maximizing the long-term growth of free cash flow per share. And as we explain that to earlier career people at TI, we have that objective because if Dwight and I owned a business, the cash we get to take home to our family is the free cash flow. And the percentage of breaking it up is the number of shares that we both own. So when you think about it, that's ultimately what we're trying to do as individuals in operating a company. So with that objective, when you look at the strategy, I've talked about our business model. It's focused on analog and embedded. I spent a few moments talking around that. And we've got 4 sustainable competitive advantages that we believe differentiates us from our peers, and we continue to invest in. One we'll talk about in a lot more detail here in a second. The second part of the strategy is having a disciplined approach in how we allocate capital to the best opportunities. It doesn't matter if you're investing in R&D, you're buying back your shares, or if you're looking at acquisitions and making sure that you're disciplined with that. And the third is efficiency. In our business, if you're not constantly striving to get more output for every dollar that you spend, you will be falling behind. So that's really important. So where have we allocated capital? If you look over the last decade, we've allocated $94 billion. That's a lot of capital. So that's why we take it very important. The vast majority of that, a little over 80 billion or so, or close to 40 billion rather, was in R&D, sales, marketing, CapEx, and inventory. It's in the business itself. It's always the first priority for spend. And what that gives us is organic growth of the business. The second is dividends. And I made the statement that our objective is to grow free cash flow per share as fast as possible over the long term. If you held that view singularly, you'd never pay a dividend, right? But we do that so we can appeal to a broader set of investors. And as an owner, it's nice to have a certain income stream that you can depend on. The next is share repurchases. So you want to do that when it's accretive to future cash flow. Gives us owners all a larger portion of the business long term. And in the last decade, we haven't had any acquisitions. Our last one was in 2011. So just before this, when we bought National Semiconductor overall. So what are we doing today? And we look at the opportunity ahead, which will drive capital allocation as we believe that the top line will be the place where we will generate the most growth in free cash flow. So to do that, we do most of our manufacturing in-house, so we've got to put capital in the ground. I think there's some books to be written in the future about how American equity markets just don't like capital spending in general. But we are preparing for it. We've got confidence in the markets that we've got growing, especially industrial and automotive. Those two markets, as you can see, over the last 10 years have grown just a little faster than 10%, and they now make up 75% of our revenues going forward. And then the third bullet there is something that's new. We're in a different world geopolitically, and we've got customers that are looking for geopolitically dependable capacity. And really what that means is outside of China and Taiwan. So we're the only company that's building at scale capacity that's outside of China and Taiwan today, and customers find that very attractive overall. So when we look at where those investments are going, we're putting those into 300 millimeter manufacturing facilities. We've got two that are complete and are beginning to ramp. One is, we call it our Fab 2 and Lehigh 1. You can see that we're real creative with our names of our fabs, named by engineers, by the way. And then we're building several new facilities. We're going to put 4 factories in Sherman, Texas. We're in construction of 2 of them. And then we broke ground in Lehigh on a second fab, which we will shockingly call Lehigh 2 overall. So with that, we can't physically take you through a fab, but we'd like to transition and take you through a quick virtual tour of one of our fabs.
Initial production is now underway inside Texas Instruments' new 300 millimeter wafer fab in Richardson, Texas, our Fab 2. TI's third and largest 300 millimeter wafer fab has more than 365,000 square feet of cleanroom space that at full production will produce tens of millions of analog chips every day that will go into electronics everywhere. At TI, we're building the next era of semiconductor manufacturing to support semiconductor growth for decades to come.
Okay, great. So hopefully you can see the scale of that fab. That factory takes about $6.5 billion when it's completely tooled and built out, and it'll produce probably somewhere north of $6 billion in revenue on an annual basis long term. So that's one of 4 factories that we are currently spending. So there's a dinner bill that's associated with all that high-tech stuff. This is a plan that we rolled out probably a little over 3 years ago now, began communicating. And we're spending today about $5 billion a year through 2026. So we're roughly through that plan. And in 2022, we had about $20 billion of revenue, and that'll give us a manufacturing footprint to support about a 10% annual growth rate. So that manufacturing footprint will be about $30 billion. And then on 26 and forward, you see a couple of lines there as we think about scenarios of how the world could evolve. But if it wants to grow at 10%, we'll be in a position to be able to support $45 billion by 2030. A couple of other things that are going on underneath the covers. We're going to bring more wafers internally, so we have less dependence on foundries. We'll go from 80% of our wafers produced to greater than 90%. And then assembly tests will go from 60% internal to greater than 90%. So that'll give us greater control as well as lower cost as we look forward to service our customers. So how do we rank when we look at just a few financial returns? So for those that aren't familiar with us, we'll be 39th percentile on free cash flow as a percentage of revenue during this heavy investment period. We're in the upper 20% from an operating cash flow when you look at us versus the S&P 500. When you measure us versus returns, we're in the 90th percentile and close to that on return on invested capital versus the S&P 500 as well. So with that, just a quick overview, and hopefully for those that aren't familiar, you're a little bit more familiar with TI now. So again, Dwight, thank you for your time.
It's awesome to be here. We go way back. We've known each other over 10 years. Davis Advisors have been long-term shareholders in TI. It's been a top 10 position for well over a decade now. Just on your commentary around capital allocation, that really sticks out with me in my mind as you mentioned that. And you mentioned share repurchase, dividend, obviously dividends per share, huge things to drive long-term value. But I've been under the impression that share repurchase is increasingly devalued or undervalued in the market. And just to put that into perspective, our ownership of TI is, you can check the numbers over our holding period, is about 35% larger, and we've never had to buy an additional share of TI. And that's a mechanism for value creation that I think is largely lost on sort of investors today with sort of a short-term mentality. But I think that number's about right. I think you've reduced the share count by a third or more.
It's more, actually, Dwight. From over 15 years, it's closer to 50%. Okay. So yes, that number is not inconsistent with that period. And I think, when you think about it as an owner, and again, when we're explaining to early career people of like, well, why are we doing that versus investing in a new fab or in more R&D? And the answer is, well, first, that's the first priority. As I explained, we want to put as much money into the business to get the type of returns that we can. But once you have done that, what's left over is the cash we take home to our family. Well, how do we do that? Really only two mechanisms to do it. It's through dividend or through share repurchase.
Exactly.
And in the near term, you don't get a check for repurchase, but what you get is a larger portion of our shares. So if you and I owned a business and our third partner was Mr. Market, and we each owned a third, if over time, if we completely bought out Mr. Market, we would both own 50% of whatever cash we're generating. So that's kind of a simple way to think about it. And it's an important element to capital allocation. Now, again, you don't want to do it at any price. You got to do it at a price that's accretive to us as owners, because we know Mr. Market can be fickle and can be manic or depressive. And if they're very manic, you probably want to let them go and let them run for a while. But if you can buy those shares at a fair value or even less, it works out well for us.
Yeah. Well, and I think I've shared this with you before, but I was recently in a meeting, a private meeting with the CEO of a former CEO now of one of your largest competitors, especially in the embedded space, and he quipped. He's a Texan, so it was a little bit of a Texas drawl, and he spoke out rather exasperatedly. Texas Instruments. Sand goes in one end and cash comes out the other. That was his criticism. But from our standpoint, as large TI shareholders, we were very appreciative that even your competitors recognize that there's great value in what you do.
That's right. There's a lot of stuff that happens in between, but we try to make it look simple.
And by the way, he's a former TI executive too, as many people in the industry are. Hey, if we could, Dave, could we talk just a little bit about industry structure, if you will? I mean, I think TI has sort of made a name for itself by going against conventional thinking. And today, conventional thinking is that the model that prevails in the chip industry is fabless plus foundry.
Right.
That the model that the best economic structure is for specialists and the alignment of interests. And you guys have been a customer of foundries. You mentioned that you're using them less, but in many respects you're moving away from this model that is increasingly proving dominant. Is that a risk, an opportunity, or why in that respect is TI moving in a different direction?
I know, it's a great question, and I think that we've been doing these capital allocation, and I should have mentioned too that the slides that I used are a subset of what we shared in February in our capital allocation call. We've been doing a capital allocation call for now more than 10 years. So we've been talking about our 4 competitive advantages, and what they are real quickly. The first one is manufacturing and technology. The other 3, just real quickly, are the breadth of our product portfolio. The third is a reach of our channels, and the fourth is diverse and long-lived positions. So we've been talking about those 4 competitive advantages, investing to strengthen them. And when we talk about manufacturing and technology, now it's 2 things, it's not just one. but it gives us lower cost and greater control. And of course, when we talk to most on, you use Wall Street in quotation marks, like, oh, lower cost, tell me about that, right? And the fact that we build, and as you see these factories, they're 300 millimeter factories, they're the most advanced processing factories in the world. It translates to 40% lower cost advantage for us overall. But the other is greater control, and that kind of, nobody paid attention to that. But as we went into COVID, and all of a sudden people look at, well, you know, who's actually building those wafers? Who's assembling the products for you? Where is it being assembled? Now we've got trade tensions to worry about, and we don't have to go to a third party to convince them to build our manufacturing plants for us. We can decide where in the world we want to build those factories. And more importantly, the technology that we build on, we control. So many of our peers, if they wanted to build a new factory or bring more stuff in, they'd have to go to those suppliers and get a license and ask permission to be able to do that. And when you think of the world, perhaps through the lens of Porter's 5 forces, and say over the coming decades, who's going to have more control in that relationship between the supplier, the foundry, and the semiconductor company, try to give the advantage to the foundry over time. So we think that'll be an advantage that just continues to grow, but we get benefit from today.
That's terrific. You know, it's when we're speaking to chartered financial analysts at this meeting, and I'm sure that when they first embarked on that career and that study to become, equity analysts, financial analysts, you know, it was drilled into them on their very first day in class. Inventory is bad.
Inventory is bad.
You know,
there's a lot of CFOs that have come from that class as well. Yes,
you do not want a bloated balance sheet.
Right.
You know, it is the enemy. It is the absolute enemy of your primary objective, which is to drive free cash flow per share.
That's right.
Know? And so, you know, if you could, that sort of speaking to that mindset of TI is going to go against conventional wisdom. We always have, and we're going to have conviction in what we do. Your CFO now talking about 200 days of inventory as not being enough, which is an outlandish number for the most part. But can you talk a little bit about how inventory, other than being sort of a cash consumption on the balance sheet, is actually a competitive advantage? You've talked a little bit about that, but I think it has something to do with having over 100,000 products and 80,000 customers. I think that's probably
there's a number of reasons that have driven it up, and yes, it is. And we've built inventory into a position of where we want it over the last few quarters as demand has weakened. So. That certainly has generated lots of questions from investors because of that view. And being at the company as long as I have been, there was a time when our products were more focused on one customer and higher volume markets that the products would change and those products could become obsolete very quickly.
Like Nokia or Apple.
Like Nokia or Apple, to name a few. And so they were brown bananas, and you didn't want to get stuck with any more inventory than you wanted. We'd often run the company probably closer 70, 80 days of inventory back 20 some years ago. But now our markets and products, it's not unusual for products to last for a decade or two. And in fact, the average time for a product to reach its peak revenue in the industrial market is 13 years. That's the average it takes for that product to peak. And then it could run at that level for a decade or two after that. So
what's the margin profile in that second decade?
They're very high, as you can imagine, right? So we always think of risk of obsolescence when we build inventory, when we start a wafer. And again, from the owner's view, right, what we worry about is putting that wafer in the trash can, because that's real dollars out of our pocket that goes away if we have to put that in the trash can. So as long as we have confidence that at some point we will sell it in the future, now you have manufacturing plants like the one that you saw, or the assembly test that maybe an assembly test that may take 30 minutes to run 30 days worth of product on a particular SKU. And it may take 30 minutes to tear down to set up the next SKU. Well, if you did that all day long, your asset utilization is now 50%. So if you've got confidence that you can build a year's worth of demand, as an example, or 6 months worth of demand on that product, and you did that all day long, all of a sudden your asset utilization goes up quite a bit. So we have that. We've also moved, as you know, Dwight, to move closer, more direct to our customers. And we've got different ways that we digitally connect to our customers where they can place demand to us via backlog or a consignment feed from their planning systems, or there's a digital way that they can connect to us in what we call the TI store, where we want to have immediate availability of essentially all of our products. So they'll pay a premium for that immediate availability, but it's a relief valve because their planning systems are never perfect. And so those are some new things that we've put in place that are just beginning to evolve. But we think that, again, that goes back to that competitive advantage of reach a channel and things we're doing to strengthen that, just to be easier to do business with, have higher availability of our products, stable lead times, and in different ways that they can get our products over time.
Yeah. You know, what a lot of folks that maybe aren't sort of embedded in the semiconductor industry probably don't realize is that I think still 75, maybe 70% of all chips move through a distributor.
Right.
They don't go, it's not TI selling their products or, well,
yeah.
We'll get to how TI is different again. Right. TI running against the current again, or swimming against the current. But, you know, does it make sense for an industry as complex and so strategically, politically critical, we found during the last chip shortage, to have 70 to 75% of its product moving through a layer that is just an aggregator and a reseller? And could you explain a little bit about how TI's approach to sort of move in an exactly opposite direction in terms of distribution?
Yes, yeah. So as I was mentioned earlier in my career, I spent 8 years out in the Bay Area and Silicon Valley in sales. So I worked very closely with the distributors to know how they had operated. And I think the myth is that we might call on 1,000 customers and the other 99,000 would be left to distributors to create demand and then to service. And as we, about 15 years ago, began to look to strengthen that competitive advantage, which is the reach of our channel, we knew we had a lot of web traffic across our website, but we had no insight to what that was. So we began to invest in tools, and fast forward 15 years later, we get somewhere around 100 million sessions with our customers' engineers where they're coming and working on their projects, getting information on our products, technical specs, application designs, reference designs, product notes, those kinds of things. And at any given time, we could have tens of thousands of projects working their way through. So that's demand creation. And we noticed in that investment that distributors played no role in creating demand for our products. We could see it through the interaction on the web. So we stopped paying for demand creation probably about a decade ago or so with distributors, and then just recently allowed not just the top 1,000 or so customers place orders to us directly, but opened it up to everyone. And we had to put in place the infrastructure to do that. So think of product distribution centers that are the 3D cubes that can pack and ship any volume. We also relocated other high volume distribution centers next to our ATs over time so we can service the world from those sites. And today we've got, as I mentioned earlier, the ability for customers to plug their planning systems directly into ours. And you think about the next decade as we capture ordering patterns and what customers are buying and how they're buying them, whether that's directly through TI or through the TI store, we'll have a tremendous feed into being able to plan our factories, our inventory levels, ensuring that we're anticipating what those customer needs over time. If you're using a third party for 99,000 of your customers, that all gets aggregated into one or two buckets of your distributors and then sent to you. And there's no information in that overall. So again, we think it's just one more way that we'll be able to be easier to deal with and provide better insight and help for our customers.
Dave, it's interesting thinking about distribution and inventory. We have recently passed through one of the most calamitous periods of time from both the COVID, market meltdown, the cycle that created, and then immediately going into a period of shortages, the likes of which I don't think anybody in the industrial markets, your core markets, have seen before. Can you talk about what you've learned at TI? What's that taught you? Has it increased your conviction? Because I know you had shortages, even with all that inventory that you were amassing, and with TI.com, the ability to sell directly or for customers to pull from TI themselves, and your consignment programs. How did all of those programs fare during the chip shortages? If you had any do-overs, what might they be, and how might these programs look in the future? Yeah, no, there are a tremendous amount of learnings through that, and some similarities when we looked at other crises we've had, 08, 09, and back to the dot-com bubble. And all of that's going into our planning and our systems going forward. And if you remember, I know you remember, Dwight, when we, I think it was in March of 2000, just as we were entering in, we got on an earnings call and said, hey, we're going to continue to run. All of our backlog has evaporated. If we look at our backlog, the sun will never come up again. Our customers will never build another product. That's what they're telling us. And we decided that we're going to continue to run our factories at the same level we were running them before, which meant we're going to build inventory. Cash was going to be consumed doing that. And the biggest concern then was, well, how do you know when demand will come back? And we didn't. But we knew that the products we're going to build were, going to have on the shelf, it could last 10 or 15 years if we needed it to be. And we never guessed that demand would come racing back as hard as it did. And one of the lessons we learned was we didn't have enough capacity in place. We ran out of capacity. So that buffer of inventory, I think, served us well for a little more than a year, probably maybe even 18 months. But that got pulled dry. We started every wafer we could, and we still couldn't meet demand. Being in sales, I like to joke, over that 8 years, I never once took a double order or an order that went into inventory. Nobody admitted it, at least. But you don't know. And that's the actual truth, is that a customer doesn't mark, there's not a box on there that says, this is a double order, here you go. And it just comes in as demand, and customers will tell you, I need that, right? I need it, and I need it today. But over time, what they will do is any market that experiences shortages, people build inventory. We talked to my wife about toilet paper during COVID, right? We had more inventory exiting COVID than before, toilet paper in the house than what we needed. Semiconductors were no different, right? So, and you saw markets kind of went into came out of the pandemic at different rates. PE was first, automotive was last. PE rolled over first, automotive has just rolled over here recently. But I think the ability to understand what your customer actual demand is by keeping lead times stable, and relatively we kept lead time stable, but we still had lots of shortages. And then having a relief valve to TI.com for immediate availability, we think they're not going to mitigate cycles going forward, but it may dampen them to some degree if customers have confidence that they can get your product. So those are some of the lessons. There's others of not taking on non-cancelable, non-reschedulable orders. We never thought that was a good idea. Yeah. That was very unpopular at the time when we weren't taking it. It's a lot more popular now as that unwinds at some of our peers. So again, treating customers as they would want to be treated, whether you're in a shortage period or not raising prices like some of our peers did, and really taking care of them over the long term, we think will serve us very well. That's great. Maybe we can talk a little bit about geography. I was in December. I was in Asia. I was in Korea or Taiwan and China, meeting with a bunch of chip companies, foundries. And at last I checked, there were over 2,000 fabless chip companies just in China. And that number is growing very quickly. With trade restrictions and a kind of a semiconductor Cold War, if you will, that's sort of dominating the narrative today. There is a ferocity of competitiveness, necessity being the mother of invention. Have you noticed, or do you expect that there's going to be more competitive, stronger competitors coming out of China in your core markets, whether it's embedded or analog? And what do you think your strongest competitive advantages to fending off those competitors might be?
Yeah, so first, we track very closely about 85 competitors. Somewhere north of 60 of those are based in China. So I didn't know, I hadn't heard a number of 1,000 or 2,000. But even on the list that we get into...
They're not all analog companies.
Tens of millions of revenue per quarter. And those are the public ones that we can get information on. And so first, most of them we've competed with for a decade, some as long as 2 decades. And they're also, they've got good products. They've got talented engineers. And we don't dismiss them. I think there's a common mistake that Western companies will say, they just want, they're just building commodity stuff, and we don't compete with them in that particular market. For us, there's 65 product lines. There's probably not a product line we don't face competition from one of those competitors in China. So we take them very seriously. We believe we can compete very effectively against them, even in China. Now, we're going to face them outside of China as well, depending on how the world evolves. But there's not one semiconductor company, I believe, inside of China that just wants to be a low-end, domestic-only supplier. So, but we can compete with them because we've got back to those 4 competitive advantages. Their designers are creative. We can learn from them, but they only can design their degrees of freedom are in design. So they're really creative in that. They're good, but we own the process technologies. We can have tweaks to that. We own the design flows, the design libraries. We own the package technologies, the packaging assets, how those 2 things are married and brought together. So we've got multiple degrees of innovation that we can bring to our products that we believe they just don't have access to. The second is because we own those assets, we're not counting on a third party to manufacture them, and whether that's a foundry or what our industry is known as an OSAT. And then the reach of our channels, the breadth of the portfolio just allow us to engage with more customers. And maybe lastly, in that geopolitical dynamic, as our customers went through the pandemic and had supply chain disruptions, many of them put together teams to look at resiliency. And when they look at where their products are coming from, some of them are shocked. 60-70% of their products are sourced wafers in China, 80-90% assembly tests there. And that gets to the CEO level, it gets to the board level. And we're like, we don't want that going to 90%, we don't want it to go into 100%. So what are we going to do to bend that curve? And that's where they'll describe it as geopolitically dependable capacity. And that's where the assets we have going in place are highly sought after.
That's terrific. Do we have questions or shall I keep going?
We do, but please keep going because I'm kind of collecting them right now and prioritizing.
Okay, just give us the high sign when you'd like to jump in. So we do appreciate the questions.
Absolutely. Well, a major investment criteria for us at Davis Advisors is management. And one of the striking things about, and we've met with so many people over the years, over decades of so many people at TI, seldom do you meet anybody that's been there just a year or 2. People stay.
They do.
There is a culture there. There is loyalty there, and we've recently experienced the retiring of a legendary CEO.
Indeed.
Who very much sort of shaped the vision for the company.
Yes.
Can you talk a little bit about his successor, Haviv? I've had a number of meetings with him, but maybe from sort of an insider's perspective, what changes do you think he might bring to the company? What are his specific strengths that he actually brings to future success for TI? You think?
Yeah. So Haviv, like many, as you just described, has been with the company some time. And I was sitting in a meeting with him, and someone had asked him, "Hey, how long have you been at the company?" And he said, 25 years ago today. It just happened to be that day. I'm trying to remember what it was. It wasn't that long ago. So it's just now over 25 years. He came to us through an acquisition. We bought an Israeli short-range wireless company back when we were investing in wireless technologies. He has run businesses both on our embedded side as well as in the analog business. He had run the signal chain business inside of analog for a number of years, and he was the chief operating officer for about 3 or 4 years before he became CEO just a little more than a year ago. So now Haviv has been on our senior executive team for probably about half of that time. So he very much was part of creating the strategy that we have today, as well as implementing it. So when he's asked the question internally of, hey, what's changed? What do you expect to change as CEO? He said, you'll notice there's a different accent, and I'm a little bit taller than the previous guy, but other than that, not much change. So again, he's grown up in the culture. He's grown up in that ownership mentality. He has played a big role in the strategy. So you haven't seen any significant change and likely won't. Now, he's a different person than Rich, and he'll make different decisions as we go forward. But I think that the point of view of how those decisions are made won't change.
That's terrific. Can you talk a little bit about the changes in sort of this is a little bit technical, but with the era of AI is bringing about different topics.
Yep.
And we're not going to talk about AI.
Right.
I know your data center market share. Maybe people are more interested in that. But
Right.
I recently was out in San Jose at Intel's Foundry event, and the era of monolithic die supposedly is over. We're now into tiles. We're now in sort of systems of chips, which is what they're describing it. A lot of the technology is being geared towards that. One of the protective aspects of the analog market is that they don't embed very well. They don't integrate very well. They have their own quirkiness, their own electrical properties. That's not economical.
Right.
And when you shrink them down and sort of give them a big dose of Moore's law, they perform worse.
That's right.
So
higher cost and worse performance, usually not a good combination.
Not a good mix.
Right.
But in this area of sort of, if we're going into sort of a systems of chips era, does that open the competitive possibilities of companies that have either advanced packaging or have a digital business, leading a digital business, to basically include analog functionality in sort of advanced packaging systems? Or do you think that the protection of analog as a discrete specialist domain sort of persists?
Well, again, the die that the reason why they've existed as separate products is the semiconductor process that they're built on is different from the ground up, right? And we don't benefit from Moore's law, and hence why we don't use it because of the reasons that you've said. So I don't think any of that changes going forward as these things get more integrated. And then if you look at systems and, looking at our factory floor as an example, that's not going to be run by a couple of chips, right? There's tens of thousands of chips in each of those systems. If you look at an automobile, it's not unusual for us to have 300 or 400 SKUs in a combustion engine car, 1,000 SKUs in an EV. And those products sit anywhere from the turn signal on the back end to the headlight in the front end to the cluster display. Again, that's not going to be one chip, right? That they have different needs and different capabilities that are kind of spread throughout the car. So again, I think as the world becomes more compute intensive, the connections to it are just going to grow overall. Our smartphones aren't going to get dumber just because we've got smarter servers sitting behind them, as an example. So
that's great.
Yeah.
Any questions?
Yeah, I think we are ready with one that's actually kind of connected to that. One of the people on the chat is wondering about how you are viewing what seems like a massive amount of change that is facing the automotive industry right now globally.
Yeah,
EV oversupply.
So the automotive market and the semiconductor content, I think last year sat around $500 in the average car. Combustion engine car is probably closer to $1,200 or $1,500 an electric vehicle. But that $500 in the average car has probably been growing upper single digits to around 10% for at least the last decade, maybe the last 15 years or so. Now, our revenues in that market have been growing in the mid-teens, so we've been fortunate to continue to gain share. And there's 5 sectors that we're investing in. So powertrain, which is going to be the primary driver of that, is electric vehicles. That includes battery management systems, onboard charging, traction control. You need things called isolation because you've got tens of thousands of volts running around there, and it'll fry the electronics or kill someone if it's not isolated. So all those things are important, but you also have ADAS, you have body and lighting, and I love body and lighting because no one in our industry talks about it. And think of a nice LED turn signal. There are some that swipe and do all kinds of fancy things. Maybe $4 to $12 of content in a silly LED turn signal. We love that. We make products for it, but we make products for all of those systems. Infotainment is the other one.
Auto dimming headlights is the one I love.
Auto dimming headlights. Who knew that we needed puddle lights that has the car emblem and spin around and things like that. So all those types of things, and that's where auto companies increasingly are driving their differentiation. Right? It's the electronics. It's driving the differentiation for the companies. And so automotive OEMs used to outsource all of that. They're pulling more of that development in-house. They want to control more of it. So we've got more direct relationships even with the automotive OEM. So now take that, which is very visible to us because either we own cars or get driven around in it, and now apply it to industrial. And think of markets like factory automation. Factories that we showed here are highly automated, but there are a lot of factories that aren't yet. Take it into medical. We can see it in appliances in our life. The grid infrastructure to be able to drive this hasn't changed in almost 200 years, and that's going through a massive change with the different types of generation capabilities and distribution that we need. And that's what's driving it in the industrial markets. And our belief that content growth is going to be there for likely several decades to come.
Okay, now because this is CFA Society New York, I'm going to ask you a couple of analyst questions.
Sure, please. Yeah.
So the first one is, how do you recommend people think about the implications of the U.S.-China trade tensions, the CHIPS and Science Act impact, et cetera, over maybe the next 3 years or so, which a lot of people have as their time frame? How do you think investors, analysts, et cetera, portfolio managers should think about those things in terms of your business? Yeah,
so as a not a very good student of world history, but I have studied it. Anytime you have a rising economic power challenging an existing one, you're going to have trade tensions, right? So we've had trade tensions with China. They've been more visceral over the past few years, but we're going to have trade tensions for decades to come. So that will always be there. That provides both risks and opportunities. I think so. You have to be mindful of it, be watching it. I think with our competitive advantages and our position, I think we're in a good position to compete if governments allow us to in the coming decades. And we hope for a world where we can compete and we don't become completely bifurcated, which seems to be highly unlikely, but I don't think you could rule it out today. The CHIPS and Science Act certainly was historic for our industry. The Semiconductor Industry Association put out a report a year or two ago, and I won't have the numbers quite right, but they looked back over 20 years and there was something like 200 plus number of wafer fabs built in the world. I think 6 were built in the US. I think 2 or 3 of those were ours. So well, why is that? It's because every other region offers a CHIPS Act-like subsidy. So as generous as this is, it's not quite as good as we could probably get in other regions, but it helps to close the gap to make the U.S. more competitive. So the next 200 that are built, we hopefully will get a larger number of those built in the United States rather than other places. So, so we think it's important. We think it helps to level the playing field. Does it put it it doesn't put us at a cost advantage. At least it helps us to be competitive on the world stage. So,
Okay.
and there are multiple parts. I think I covered the two. So
You did.
yeah.
Dwight, I wonder if you could share your view of that, because you sit in the chair that a lot of these people who are on the live stream do. How do you view and how do you do forecasts, given the uncertainty presented by the trade tensions, CHIPS Act, other types of governmental interventions?
Well, I think that it is difficult to recreate what has been built on the Pacific Rim as far as a supply chain in the semiconductor industry. I think that there's a lot of wisdom in the commentary from Morris Chang, the founder of TSMC. Clearly, he is speaking his own book, but to think that the United States is going to replicate what has been built in the Pacific Rim with $54 billion and is probably, far too optimistic. That said, I think, and even those that are building infrastructure here in the U.S., they're sort of admitting that it is not the most economic return in terms of investment. But we're talking about redundancy and resiliency of supply chains. I think it's critical to the overall scheme of things, and we should have more factory production here in the U.S. I think it is just a prudent investment.
Okay. Great. Now I'm going to change gears a little bit and ask you about how you think the analyst community can do their jobs better. So how do you all think, when you all work with analysts,
Certainly,
how do you think they do it right? What do they do wrong? What should they do more of or less of?
Time frame. That's a big one.
I think that's when I made the comment earlier that equity markets in the U.S. just don't like capital investment, and we'll get the question of, geez, do you know that that's going to take your gross margins lower? And it's like, well, yeah, that's how the accounting works. I'm an engineer. I haven't had a little bit of accounting, but that's not what we're trying to. We're not trying to maximize that number. And I also there are some where it's easy to do, and even I do this when you're working inside of a spreadsheet. Everything boils down to a number, and as we know, the real world's not quite that simple and that easy and that straightforward. So, we'll get asked the question of, well, what are you trading off, gross margins or revenue growth? It's like it's really not a trade-off. It's about where you allocate capital to, the markets that you pick to invest in, the differentiation that product brings. And if it's done right, it's going to bring both revenue growth and gross margins with it. But that said, we're not, you could be operating a business inside of TI and, our gross margins are in the mid 60s now or so, and, had danced around 70. If you're running a business inside of TI and you're running 40 points of gross profit, that's okay. But the next time you show up at a meeting, it better be moving to 41, right? And if you're at 75 or 80, the next time you better show up and it better be moving a little bit higher too. So it doesn't matter where you are. So it's never like one number. It's always the balance of all of those things to produce ultimately what outcome you want. For us, it's generate more cash. That's what we're trying to do, and trying to do that over long term. So,
okay. Let me just drill down into that for 1 second, because we do have sort of a spreadsheet question as long as we're there. How do you all think about capital capacity versus the way your competitors think about it? And if, for instance, are you okay with growing capacity at 10%, or would you be willing to take more market share with a cost advantage? How do you sort of square that circle?
Yeah, so let me speak for us, and then I can make observations of what our competitors are doing. So I don't want to or even intend to speak for them. But we've got to put in place the capacity that we believe we could have the opportunity to grow to. Because if we don't, we won't be able to take advantage of that opportunity. Very, very straightforward. That may not seem so obvious, but we're not asking someone else to build and put in place that capacity. So we've got to put it in place ourselves. The advantage of our business model is we'll use these assets for decades. So when you look at the return on them over time, if it ends up being a year early, 6 months early, 2 years early, is that a lower return? Yeah, but in the grand scheme of things over the next 30 years, they're not going to change the return profile very much. So that's why we want to have capacity in place ahead of demand. We have a saying that we use: we'd rather be 2 years early than 2 months late with capacity. So you never got profit on a wafer you couldn't build. And now I think most of our peers, and Dwight mentioned this earlier, it's like, well, capacity, to put capacity in place yourself, you've got to spend capital. Capital, like inventory, is a bad word. If I can outsource that to someone else, my P&L will be more stable. So when revenues come down, I don't have to worry about the impact to gross margins. And isn't that what we all want? Just higher gross margins. Well, as an owner, I'd like more cash, please. But but there's a focus on those things, which I think is. I understand why they're there. I see and feel the pressure of why some investors would want to have that, but ultimately it's not going to gain us more value in the marketplace. So,
with all the focus on gross margin, why haven't you increased your depreciation for production equipment like everybody else?
Yeah, I've been asked that question. It's interesting. I've been asked that question a few more times.
We've had that.
No. Yeah,
this is just for our audience. We've had this conversation.
And the CFAs will appreciate this. We straight line depreciate our equipment over 5 years. And back in the day when we were investing in Moore's Law, Moore's Law is every other year. So your assets were good for maybe 3 to 5 years, and then you needed to move on and rebuild your factory. So that's where the history of that came. Essentially, because we'll run it for decades, there's some good accounting reasons of why it stays at 5 years. But ultimately, as an owner, if you think about our CapEx spend being steady over a period of time, those two numbers of cash flow and the income statement
doesn't impact cash flow.
It doesn't.
Yeah.
And we tell you what we're spending and that we're depreciating. If someone wants to take our numbers and spread it over 10 or 20 years, have at it. You could do that yourself, right? And so again, we just we'll leave that alone. The companies that have changed their depreciation schedules, the amount of grief that they take for it, we'll let people do their own work. So.
Right. And one last question. Are there subsectors of your company that you're expecting to have revenue shortfalls in the short term?
Not so much areas, but I'll just talk about markets. As I talked about, the markets were bifurcated. I think it was second quarter of 21 that we first saw weakness in personal electronics. It took 6 quarters to bottom, and we've had growth from that point forward. At the other end, we've had automotive that had a 3.5-year strong run off the bottom. It tripled in size over that period of time and has shown its first sequential decline this last quarter of 5%. So when we look at 30 years of history, there's never been a market that's corrected in one quarter. Is that going to be weaker? It likely will before it corrects, but we don't try to predict that for ourselves or for the market. Overall, we'll let that run where it wants to. So.
Thank you. Yep.
Hello, Leo Schmidt again, and I want to thank Dwight and Dave very much. I want to say my one personal takeaway that I thought was pretty unique is that you're taking assembly and test from 60% in-house to about 90%. That's a huge change, and it should be a phenomenal opportunity. Thank you again, and I just want to mention that the CFA Society, you do not have to be a CFA to be a member, and if you like events like this, you can keep coming for much lower costs. Thank you.